And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. It is, of course, the week before Christmas, and all through the house, Brent was not stirring. So there you go. He's in the house. So here we are. It is the week before Christmas, and of course, this is a holiday shortened week, of course, in terms of trading, because markets will be closed on the later this week for the Christmas holiday, since Christmas actually falls on a Saturday. I kind of feel like I get ripped off when Christmas falls on a Saturday, right? Just feels like a wasted day, right?
Yeah.
It's just waste a holiday.
Exactly.
Falling on a Saturday.
So let's take Christmas Eve off.
We should change Christmas to being the third Friday of every month.
So long as it's not on the 13th.
Yeah, well, I wouldn't want that, would
Yeah.
But nonetheless, this will be a holiday shortened week. Markets will close early this week on Friday. So then that way, of course, the only gives us 4 days of trading. And look, market volume is already light anyway. And of course, now this week it's going to be even lighter. Of course, this morning, markets aren't looking very good here at the open. Unfortunately, now on Friday, the market sold off a bit. Did hold on to the 50-day moving average on Friday. So this has kind of been critical support. Now, we're not back down to the lows of where we were right around Thanksgiving. So we do have a little bit more downside to here today, but this downside is going to get challenged this morning at the open. So that support from the November lows needs to hold here. Now, as we've been talking about for the last, kind of couple of weeks, we're now set up for the kind of end of the year seasonal push. First week of January tends to be positive. Well, this is because mutual funds, dress portfolios, and then you have beginning of the year positioning. That's just how statistically kind of the tendency works. Does that mean absolutely guaranteed that Santa Claus is going to come to town this year? Who knows? Now, statistically speaking, if Santa Claus doesn't visit Broad and Wall, that does have some implications for the rest of the year. Now, you've heard how the first 5 days of January dictate the month. The month of January dictates the year. This is just kind of statistical trends over time. But again, what all that is if you don't see that kind of positioning, put into place right at the end of the year, it kind of really bodes well for a change in psychology, people getting more cautious on markets and positioning going forward. So again, that's the one thing we're watching here closely. Again, markets are going to open down this morning at the open. And the reason, of course, was over the weekend, the BBB is now DEAD. So that the Build Back Better bill, pretty much for the most part, Joe Manchin killed it, put the final nail in the coffin as some of the headlines this morning. He's not going to vote for this kind of excessive government spending at a time where we're already running a lot of debt. And really, while the headlines are all really kind of bashing Joe Manchin for not buying off into this deal, he had said he would vote for it as long as it was pretty much paid for. And a lot of that was based on the score that came back from the CBO. So they all sent it off to the CBO, who sent it back and said, yeah, it's going to cost roughly $3 to $4 trillion over the next decade. And that was really what set Joe Manchin off at that point. He's not willing to put a whole lot more inflationary and non-productive debt in the market. It's good for him. I mean, this is something we've talked about for a long time. These programs are not good economically long-term. They give you a little bit of short-term benefit, but the long-term problems of having to pay off that debt, not having productive investment, but having non-productive investment is worse long-term than the short-term benefit. And this is the one thing, we hear from Bernie Sanders and a lot of the other kind of the socialist commentary, saying, oh, we need to give people money. That doesn't help people. It actually makes things worse for them long-term. It sounds good in the short term. It's like, hey, let's give people money and they'll have more money to spend. Yeah, they will have more money to spend, but you're going to create inflationary pressures in the economy that eat up all of that additional money you gave them plus more. And this is always the thing that we forget, is that non-productive debt does not lead to long-term economic prosperity. And that's really the things that we want to be focusing on. Getting people back to work, helping them create jobs. If you want to give people a hand up, right? that's fine, but giving them a hand out doesn't get them there. It actually makes things worse for them. So if you want to create an economic prosperity cycle within the economy, create jobs, provide training programs, teach people how to weld, how to do construction, how to do work on cars, those are the things that people always need. Plumbers, electricians, those will always have a job. Somebody needs that work all the time. Trust me, Brent never fixes a toilet. So that is just...
That's where I draw the line.
That's where you draw the line. He'll fix a sink, not a toilet. There you go. But this is where we've kind of lost our way in terms of government programs. It's easier just to give people money, and it sounds good, and it's a great way to buy votes, but it doesn't help people long-term create better economic prosperities. But again, the killing of that additional liquidity, right? This is kind of the markets we're looking for next year in terms of economic growth, that all this liquidity coming in from the Build Back Better program, the infrastructure bill, et cetera, all lift economic growth. Now, part of the part that's weighing on the markets this morning, Goldman Sachs cutting estimates for economic growth in 2022 by about 0.5 point a quarter. So economic growth is going to very quickly drop back towards that 2.5% growth rate next year, pretty much in line with normal economic trends that we've seen over the last decade. But that surge of economic activity that we had over the last year or so because of $4 or $5 trillion worth of liquidity, that's now going to return back to norms. The important thing about this is when it comes to the stock market in particular, though, that's also going to mean pressure on profit margins. One of the things that has been really kind of driving the stock market here over the last several months has been expectations of these, really accelerated earnings growth, rising profit margins, all these type of things. Well, that's all going to come under a lot of pressure next year as we begin to see slower economic growth. That's going to create more pressure on profit margins. Combine that with higher rates of inflation, that's going to weigh on profit margins and earnings reports as we go forward. So again, seeing a bit of repricing in the markets here short term is not surprising. Again, doesn't take away the probability that we've got to do some repositioning. Markets are starting to get back towards oversold levels. Probably by the end of this of today's actions, we'll be back more to oversold levels. Again, while we haven't seen that Santa Claus rally yet, the markets are kind of setting up for it. The one kind of negative that we're watching very closely is our money flow sell indicator is very close to tripping over into a sell signal, which would suggest more pressure on market short term. Again, doesn't mean that's got to happen. We'll have to see kind of how the market works out today. Important though, as we kind of go back to what we talked about a few minutes ago, important the markets kind of hold those support levels back from November. If not, there's not a whole lot of support down to about 4,400 on the S&P, so a little bit more downside drag over the course of this week. And again, light volatility this week, nobody's around. Christmas, and then people come back for trading after Christmas through New Year's. Not a lot of people around for that either. So again, over the next 2 weeks, we already had a lack of liquidity problem. That liquidity is going to get a lot more thin over the course of the next 2 weeks, which is going to suggest there's going to be a lot of volatility. So be careful, knee-jerk reaction to movements in the markets, because these things are going to be whippy all week long, and you're going to sell, try to buy or sell and likely be on the wrong side of the trade. And that's just kind of, history. History says that that's kind of the way it's going to look like over the next couple of weeks. So just be a little careful. Watch your exposures here, of course. Keep your stops in place. But again, try not to make knee-jerk reactions on daily moves, because they're going to be all over the board for the next 2 weeks. Okay, come back. We got a lot of stuff to get into this morning. Be sure to get by the website. Our latest blog posts are out. Our newsletter's out from this weekend. New revised format, lots of new charts and analysis on markets in the newsletter. So simply go by the website, click on the newsletter link, and if you're not getting it by email, just subscribe to it, and we'll send it to you every weekend as well, so you have it in your inbox. Be right back after the break for more of The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Don't let 2022 be a repeat of the past year. Join Danny Ratliff and Richard Rosso for their essential smart money tips for the new year Candid Coffee event on Saturday, January 15th. You'll learn the landmines to avoid, tax advantages we see, and money tips you need to know in the new year. Register now for our next Candid Coffee at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso. realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency, 888-915-0780. RIA Insurance Agency, 888-915-0780. 888-915-0780.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. It's 6:17 as we kind of get this morning edition under the way. Of course, it is Monday, the week before Christmas. And the bad news is if you haven't ordered it yet, it ain't coming on time. So just prepare everyone. Everybody gets a Christmas card this year with pictures of what they'll get after Christmas.
A Christmas IOU.
Exactly. You know, it's our good friend, Mattress Mac here in Houston, Texas. Of course, he has a gallery furniture. One of his old sayings was that, shop at Gallery Furniture, and that way you don't sit on a back order slip. And not that he stuttered. That was just
That's just how he does it.
That's how he does it. And, of course, this year, a lot of people are working off back orders. Mm-hmm. So, again, it's part of the whole supply chain problem. And talking to my neighbor over the weekend is a good example of this. They just went and bought a new vehicle. And they traded in their used car, and he was very excited because he got almost as much for his used car as he paid for it. And that just kind of really shows you kind of where we are. But there was kind of two interesting points that he made in terms of this, transaction that he did on buying this new car. So he traded in an old Palisade that he had, and it's held almost all of its value. And that's just because of the shortage of used cars right now. People are paying a nice premium for used cars. And then, of course, buying the new car, there were certain features that were missing on the car because of lack of semiconductors. So it really just kind of shows you, the trade kind of shows you where we are kind of still in this auto cycle that we're in because, again, there's just not enough components on semiconductor side. Batteries are in short supply. Just can't and cars are being produced and put out that are lacking features because of the lack of semiconductors. So it's just, and then of course on the other side, people are paying huge premiums for a depreciating asset. They're overpaying. I think about that for a minute. People are overpaying to buy a used car that depreciates. Now, the value of the used car right now is very elevated, but as soon as we solve, any type of supply chain disruption, the value of those used cars are going to very quickly revert to where they are, which means that when somebody goes to trade in that used car, the depreciation on the value of that used car is going to be much greater than it would have been normally. So, especially if used car prices return back to just kind of normalistic levels. The loss of value on this. Now, this is going to be tough for a lot of people and consumers in particular. And this is one of the side effects of what you get from shutting down an economy and creating these shortages. But for a lot of people, when they buy a car they know it's a depreciating asset, right? So they're going to be smart about it. They're going to buy a used car because it has less, has the depreciation kind of already built into the car. They get a loan for it. They go drive around on it for 2-3 years. They go to trade it in. And what they're hoping for is that maybe the equity value in the car is about even on the trade-in. In other words, they don't have a lot of negative equity. And one of the things that we're going to see over the course of the next couple of years is people trading in vehicles and picking up a lot of negative equity, and which means that negative equity has to get rolled into the cost of the new car they're buying, whether you either used or new. That negative equity gets rolled into the cost of that car, which means that they've got a bigger loan balance on that car going forward, which means that car doesn't hold value, and then the negative equity continues to roll, and it rolls until the point that they can no longer afford to buy a car. So the point about this is this is all going to kind of push forward future demand for vehicles. In other words, people are able to buy cars and roll them over, but that negative equity build is going to eventually force people to stay with the car. Rather than trading a car in every 2 or 3 years, they're going to have to hold the car a whole lot longer to try to work out of some of that negative equity position. They're not going to be able to make that trade to roll it in. This is going to push out the demand for cars in the future to where people are holding on cars longer. That's going to drive down value of cars and reduce this kind of demand crunch we've got for cars currently. So this is all what's going to cycle over the course of the next few years. And again, kind of the boom and bust in the auto cycle is not, anything new. We see this all the time. It's just, as you think about what's happening in the economy, we've done two things in the economy in particular. So by shutting down the economy, we created a lot of artificial demand for stuff. People panic when you take away stuff. So, if all of a sudden you say, hey, you're not going to be able to go to the grocery store and shop, people run to the grocery store and they buy a whole bunch of stuff they don't even need, right? They go into hoarding mode. So we create a lot of artificial demand when we shut down the economy. Then we open the economy back up. And unfortunately now we've got more demand than we have the ability to produce supply for. So you have the supply-demand imbalance. So you have these shortages, which are driving up prices, which drives individuals to buy more stuff they don't really need, but they buy it because they may not be able to get it in the future. So when they go to the store and they see, 4 bottles of water on the shelf, they're going to buy all 4 bottles because, well, everybody else is buying it out, so they better get it while they can get it. And it's just a psychological issue. And if you go to stores right now, you'll see a lot of this. You'll see certain pockets of the store it'll like on the shelves, they'll be completely empty. And people are just, and when people go down that aisle, they go, oh, wow, man, this stuff's almost empty. I better buy some. I don't really need it right now, but I better buy it anyway because it may not be here. So we create these supply-demand imbalances, and what we're doing is we're dragging forward all this future consumption so that when we get to that point in the future, what'll happen is that this supply crunch we have, in other words, these manufacturers and producers, et cetera, they're all ramping up the ability to meet what they perceive to be increased demand. So they're going, man, we're selling out of everything. We produce it and it's already sold. So they ramp up production. So that supply comes up. And as supply comes up, demand will fall because you have more supply now. People go, they go to the store and there's plenty of water on the shelf now. So I don't really need it right now. I'll get it next time. So that psychological shift drives down the demand. And now you have an oversupply of product. Prices fall. You get deflationary pressures. Again, just economic cycles. The problem is that as individuals, we don't really think that far ahead. We kind of react to the moment. So right now, there seems to be a shortage on everything. I better go buy a car or a bottle of water or whatever it is. I better go buy going back to, where we were during the freeze, right? Better go buy toilet paper. May not be able to get it. Plenty of toilet paper out there. Just relax. No, not going to run short of toilet paper. There was a funny video on the weekend, and this wife's talking about her husband because her husband, her oldest son moves out of the house. And moves into his place. Now, he's, lived with his parents growing up. Then he lived in college in the dorm, right? So then he was in the military. And so he moves into his own place, and he calls up at 4 o'clock in the morning and says, Mom, where's the toilet paper? Well, every place he's been, the toilet paper's always been supplied, right? And so he's got no toilet paper. Yeah. And so she says, well, you have to go to the store and get the toilet paper. About 4 hours later, she hadn't heard from him, so she calls back to make sure everything's okay. And she texts back, she says, is everything okay? And he texts back, coffee filters. So at least men are creative.
Yeah.
Right? I'm just saying, they're never short on toilet paper.
Necessity and the mother of invention.
Exactly. So coffee filters are always in stock. Just in case you're ever short of toilet paper, coffee filters are in stock.
Talk about roughing it.
Well, when I was growing up, my dad used to regale me with the tales of the Sears and Roebuck catalog.
Oh, yeah. My dad regaled me with tales of leaves.
Yeah. Now, see, if you're not old enough to know what we're talking about back in the 30s and 40s and 50s when our parents were growing up. They had outhouses. They didn't have indoor plumbing. And so in the outhouse, you would go to the outhouse and there'd be a Sears and Roebuck catalog. Mm-hmm. Mm-hmm. That was your...
dual purpose.
Shop and cleanup on aisle 6. So anyway, I don't know how we digress there. Supply and demand. That's where we were. So anyway, this is, the point about that is that ultimately, people do shift psychologically, and they start to fill those gaps in supply and demand by changing their demand for products or looking for alternatives to products or producers just simply start producing more than actual demand is. And again, so this is all going to affect the economy as we go forward. And a lot of this inflationary build we see in the economy short term has really been driven by two things. One, and we touched on this a few minutes ago, we had this $4 trillion, $5 trillion worth of liquidity being thrown at the system. So all of a sudden, everybody had excess cash to spend. Well, the average American isn't brilliant. So what did they do with the money we gave them? They spent it, right? They didn't save it. They spent it all. And they went and bought a bunch of stuff. They went and bought computers. They went and bought laptops. They bought phones. Whatever they wanted to buy. They were trading stocks on Robinhood app. You name it. But we were giving them money, and they were spending it almost right away. So not surprised, we saw this big surge in demand for products that we couldn't meet. And that created that inflationary pressure. Now, this is one of the issues that Senator Joe Manchin has in regards to the BBB bill. So we just passed $1.23 trillion for infrastructure, and now you want to pass another $1.7 trillion for the Build Back Better plan. And what he's concerned about, rightly so, is more inflation. Right? You're going to give people more money to spend. A lot of this Build Back Better plan was not building back better anything. It was just simply giving people more money to spend. And you've already got an inflationary problem in your economy. That would only basically have thrown gas on a fire, which would have made it much more difficult to get economic activity back to more normalistic levels. Be right back after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Don't let 2022 be a repeat of the past year. Join Danny Ratliff and Richard Rosso for their essential smart money tips for the new year Candid Coffee event on Saturday, January 15th. You'll learn the landmines to avoid, tax advantages we see, and money tips you need to know in the new year. Register now for our next Candid Coffee at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso. Realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency, 888-915-0780. RIA Insurance Agency, 888-915-0780. 888-915-0780.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
You know, money changes everything. I'm just sitting here reading a headline. A changed Taliban says it's welcoming women's rights and now wants $10 billion from the U.S. You really can't make this kind of stuff up. I'm just saying. Wait, there's money if I'm good? Okay. Apparently my kids are now the Taliban. I'll be good if you give me money.
Until they get the money.
And then they turn back into the Taliban.
The Real Investment Show podcast. Same show.
That's my kids.
At realinvestmentadvice.com.
They've been terrorizing me for years. Anyway.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Join Danny Ratliff and Richard Rosso for their essential smart money tips for the new year Candid Coffee event on Saturday, January 15th. You'll learn the landmines to avoid and money tips you need to know in the new year. Register now for our next Candid Coffee at realinvestmentadvice.com with Ratliff and Rosso. Realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. I'm Lance Roberts. Brent Klein joining me this morning, of course, as we get into this week before Christmas. All right, so holiday short trading week, volatility is going to be all over the place. So, don't read a whole lot into the market. And one thing is also just be careful here. This market's going to be very whippy over the next, few days as we wrap up the year. So again, what you may see at the open this morning, be careful panic selling, on a down day, because again, these are the type of days that by the end of the day you can be back to positive territory, right? There's going to be such light volume and low momentum that these markets are going to be just all over the place. Open up strong, wind up negative for the day type thing. So just be careful, right? Just manage accordingly. Vancouver expects to be the first city in Canada with an all-electric fire truck. This is interesting, right? The electric fire truck costs $300,000 more than a diesel model, pumps 40% less water, and it needs a diesel extender to actually make it useful. This is the problem with, this whole rush into, green technology, et cetera, is that they're not efficient. It requires the carbon footprint on these things are actually larger than the proposed savings that you get by having an electric vehicle. But, this is kind of where we are, right? We've got this psychological shift that's going on within the country right now, trying to kind of forge out this new direction into a cleaner, more sustainable, environment. And, this has got implications for, and don't get me wrong, there's nothing wrong with any of that, right? It's just, it has implications for the future of work, skill sets, etc. I was listening to a video over the weekend talking about jobs and employment and, fair wages, kind of the normal conversation. We hear this a lot, right? People need to be paid a fair wage. And, we've talked about this on the show before, is that there is no minimum wage. Your minimum wage is zero. That's, what you bring to the table, your skill set, your work ethic, those are what determine your wage. Very few people in this country actually work for minimum wages. And if you are working, and minimum wages, as we've said before, are kind of a starter salary. It's to test you out, gives the employer the ability to test you out, gives you the ability to prove yourself. And then if you prove yourself, you work hard, you very quickly get moved up in the ladder. Most companies pay well above minimum wage. Now, the problem is technology. And, so in this video that I was watching, it was talking about a guy who was in a manufacturing job and he had lost his job and the jobs had been moved overseas and he was wanting to know when he was going to get his job back, right? And he's looking to the government to fix this problem. And this is kind of the idea with the Build Back Better plan. It's kind of the idea with the infrastructure bill is that, we're going to do these things. We're going to create these government jobs and we're going to do these things. The problem is not really something the government can solve ultimately. And this is a you problem, not a government problem. And depending upon government to fix these things leads to a whole lot of other problems. Ultimately, more debts, more deficits, more spending, and really a very poor use of capital. One of the issues is that what private businesses do very well is invest capital. And the reason that businesses are very good at investing capital is because they only have a limited amount of that capital and they have to make it work. And generally, that capital is brought in by either outside investors or they've borrowed it from other people, the banks, whatever, but they have a limited access to that capital and they have to be very efficient in making it work and becoming profitable. Otherwise, they're quickly out of business and they still owe people a bunch of debt, right? So private business owners, right, they're the most efficient at expending capital and putting that capital to work, creating jobs, these type of things. This is why small business is so very important to the economic backbone of the country. Out of 30 million businesses in the country, only about 6 million of them actually have employees. And out of those 6 million companies that have employees, about 80% of them are small businesses. And they have, 5, 10 employees, right? Look, and just think about when you drive down the street right now, just look at all the businesses on the right and left-hand side of the street. A lot of those are, dry cleaners, nail salons, mini marts, little gas stations, whatever, right? A lot of these are small, independently owned. They're owned by your neighbors. That's how these people are making money for themselves, right? And growing their own wealth. The problem is when we shift it to government, government has no responsibility for money. So they just throw it out there into the world and they say, here you go, right? We've just issued a bunch of debt, but they're not responsible for that debt. They don't have to personally be responsible for paying that debt off. Now, see, if we made Congress have to personally guarantee the debt that they spend, in other words, if that debt has to be paid off and they didn't invest it in something that would repay the debt, they had to personally pay it off, they'd be a lot more constructive about how they spent government money, right? If they had skin in the game, so to speak, they'd be a lot more constructive about how they spent your tax dollars. And that's the thing, don't forget, when they borrow money from whom? You. You're loaning the government money. And the way that debt gets paid back is through your tax dollars. So when people look at the government and say, well, look, give me more free money, it ain't free. You're paying for it. You pay for it through taxes, you pay for it through inflation. You're liable for it. You may get the money in your hot little hands, but you're ultimately liable for it. And you'll eventually pay it. So the reality is that businesses are going to export labor to the lowest cost producer. So the more that you demand higher wages in the U.S., the more those jobs are going to get exported overseas or get replaced by technology. We're watching right now, we're seeing a very big surge in CapEx spending because companies are starting to figure out ways to reduce their labor needs by automating certain areas and aspects of their business through automation. More technology, fewer employees, increases profit margins on the bottom line. And so this is why it's going to be important. And I have this conversation with my kids probably once a week at least, right? Because I've got two that are they're 18, just on the verge of going to college next year. And so they're kind of going through that, what I want to be when I grow up phase. And I'm like, that's not even a question. You don't get to pick anymore about what you want to be when you grow up. You better be picking a job that's going to be available to you when you grow up and graduate college. I'm going to go to college because I want to be a sociologist, or I want to be a vet, or I want to be, a doctor, or whatever it is. Those are all fine. Those are all fine skill sets. The question you have to ask is that a job that will pay me in the future? And I'm not saying they won't, right? I'm just saying this is the question you've got to ask. Where is the future going to be? And what is it? And this is the conversation we have. And I use the old Wayne Gretzky quote more often than I should, is you've got to be skating to where the puck is going to be. And that's what you've got to be looking for down the road. And this is the thing that we need to be telling and teaching our students coming up, is we need to be giving them access to these skill sets that they need in the future. When I was growing up and Brent was growing up, we used to have shop class in high school, actually, even in intermediate school. Now, can you imagine this today? When I was in an intermediate school in 6th grade, we were being taught how to weld. Now, can you imagine parents today sending their kids to school and they're going to be using an arc welder in school in 6th grade? Parents would be losing their mind, like, oh my God. But no, we were 6th grade, 7th grade, 8th grade, 9th grade. We had shop class. We learned to work on cars. We learned to, build things in wood shop. We had welding class. Now, when we got through school, right, and got through the semester and got through the school year, were we all licensed welders? No, that wasn't the point. The point was to introduce students to opportunity and to skill sets. And there was a lot of kids that I graduated high school with that went on to be auto mechanics and welders and construction workers and pipe fitters, and they made good money. They opened up their own businesses. But we don't offer those type of skill sets anymore, right? We don't teach that in high school. We don't teach it in intermediate school. Because, some kid arc welded his finger off, the school got sued, and, it's like, oh my God, we can't teach that anymore. Little Jimmy put his eye out. Yeah, this is the problem with society in a lot of cases. But the point is that in the future, if we're going to solve some of these economic inequalities, we've got to go back to the beginning and start teaching people the skill sets they need to reinvent themselves in the new economy. So for the guy that lost his job in the manufacturing facility, that job's not ever coming back. You've got to learn a new skill set. And the problem is we're doing a very poor job economically and government-wise of teaching those jobs to Americans. Be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Don't let 2022 be a repeat of the past year. Join Danny Ratliff and Richard Rosso for their essential smart money tips for the new year Candid Coffee event on Saturday, January 15th. You'll learn the landmines to avoid, tax advantages we see, and money tips you need to know in the new year. Register now for our next Candid Coffee at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso, realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency, 888-915-0780. RIA Insurance Agency, 888-915-0780. 888-915-0780.
What worries you about your money? Enhance your financial success with RIA Advisors' free financial planning tool, MyBlocks. It's our online modular manager for your money and your life. Does your vision of retirement match up to reality? MyBlocks can help to determine how much you'll need and how you can achieve. Create your own personal financial vision for the next decade with MyBlocks, our free tool at RIAadvisors.com. Click on the Client Portal tab, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to Social More 647. Today's blog post, Bull Markets and Why We Repeat Our Mistakes. Kind of a look at the psychology of investing this morning on our blog site. So simply go by realinvestmentadvice.com, get our latest blog post. Talking a little bit about the things that we do repeatedly over and over. And, it's interesting because I get emails every day from people, asking questions. And, if you kind of take a sampling of the questions that come in, you start seeing the psychological impediments that impact investors' outcomes long term. And we kind of go through, there's kind of 9 basic components, and we've quoted Dalbar studies before, and there's kind of 9 basic psychological tendencies, behaviors that we have as investors, from loss aversion to narrow framing, anchoring, mental accounting, lack of diversification, hurting, regret, media, optimism. These are all things that tend to get us in more trouble than not. Now, the important thing about these psychological behaviors, and again, as I said, I get all these emails, you can almost pick these things out. I get emails quite often, it's like, well, I bought this stock at, $50. It's now at $30. What do you think I should do? Well, see, they're anchoring to the $50. That's what I bought it for. So I'm anchored to that $50, right? I need to get back to that $50. I need to get my money back. That's not the way markets work. Markets don't care about what you paid for something. What you have to do as an investor is saying, I paid 50, I'm now at 30, I'm not willing to lose any more money. I've got to make a different decision. When the markets decline a little bit, I start getting emails about, oh my gosh, I got one yesterday. When's the selling ever going to end? Well, we just had a rally. So where was the email from you on the rally that says, when's the buying ever going to end? Right? We don't ever look at it that way. We just want markets just to go up and up and up, but they don't. Nothing goes straight up over time. You got if the markets are going up, you're going to have some selling pressure. And this is why we talk regularly about taking profits. When markets get overbought, it takes profits. When markets get oversold, that's where we want to start buying a little bit, putting some capital back to work. But as investors, right, we get overly optimistic. And so when markets are going up, we just, man, this is great. They're just going to keep going up. And then as soon as they start selling off, it's like, oh my gosh, when's the selling ever going to end? This is just never going to stop. Of course it's going to stop, right? And markets are going to rebound. But the problem is that we then throw in this idea about loss aversion, which is now the markets are declining. I don't want to lose any more money, so I'm going to sell everything. I'm not going to sell a little bit. I'm going to sell it all, right? I just can't stand to lose any more money, so I'm just going to sell everything because I got to avoid the losses, right? We've got to avert any future losses. This was our article we had out last week about being 100% in cash can be just as bad as the market crash itself. But that's loss aversion. Investors go to 100% cash because I simply don't want to lose any more money. And then when the market starts to rally back, they go, yeah, but it's going to come back down again. And it keeps going. And then, well, now it's overbought, so I can't get in. I got to wait for a correction. Keeps going higher. Well, as soon as it corrects again, then I'll get back in. But it never gets back to where they were when they sold out, so they never get back in. And look, we see people regularly in our offices that have been out of the market since 2008, 2009. And now trying to figure out how to get back in. But see, that's how markets work. And that's why the hardest aspect of investing is setting aside that emotional. Look, I'm emotional too. I'm not Spock, right? I've got emotions. And so when markets are moving up and down, I get emotional too. But I have to sit there and step back and say, what does the technical analysis say? What does the fundamental analysis say? And try to drive investment decisions unemotionally based on that analysis, even though my stomach may be churning up in knots. But that's part of being a portfolio manager, right? I'm responsible for all these people's money, and their money is very valuable to them. This is their retirement. This is their kids' futures. This is their futures. I mean, I've got a tremendous amount of responsibility managing other people's money. I would much rather just manage my own money. If I lose my own money, I was like, I don't care. I do. Not really, but I do. But it's just me. I mean, I'm only screwing up my future, but when I screw up everybody else's future, that's a heavy burden. And that's why we focus so much on technical, fundamental, momentum analysis, right? Trying to understand what markets are doing. And look, we can't predict. We develop tools that can give us some ability to make an educated guess at what the markets are going to do, but it doesn't always work out to be the case. But this is where, again, it's the hard part is setting aside. And look, and these emails that I get also feed into my emotional bias, right? When I start getting a bunch of emails from people going, when's the selling ever going to stop? I start questioning myself. And I've got to be careful about that because I can't be influenced by other people, right? That's herding. Herding, think like a cattle herd. If you ever notice, cows all point in the same direction when they're eating or moving around, what are they doing? They're all facing in the same direction. That's the herd. And as investors, we tend to move with the herd. So whatever the herd's doing, if everybody's buying ARK stocks, then everybody buys ARK stocks. When everybody's selling ARK stocks, everybody sells ARK stocks. This is a problem, right? Because the herd itself is typically right in the middle of a move. The herd is often wrong at the beginning or end of a move. At the beginning of a bull market, you're just coming out of what? A bear market. Back in 2009, we were trying to get people back in the market, and they were going, are you crazy? Haven't you heard this market's going to zero? We were at 666 on the S&P at the low. No biblical reference there, just complete irony. But at that point, investors were convinced we were going to zero on the index. It was over. Done. Financial markets were finished. The banks were all gone. It was the Great Depression Part 2. And that was the beginning of the bull market. Now here we are, 12 years later, 13 years later, and investors can't wait to get in the markets. Now, are we still in the middle of a move? Are we at the end of a move? Who knows? But at the end of a move, people are typically overly optimistic, and they think the market can only do one thing, and that's just go higher. That's why herds are typically wrong at the beginning and the end. In the middle, they're probably right. There is a psychological pressure on markets, and when you have a massive herd of people all doing one thing in the middle of a move, it tends to extrapolate that move. But that's how you get extremes on either ends. That's how you get an extreme in the sell-off and an extreme in the bull markets because of the herd. So when I start getting all these emails, back to my point, I start getting that same herding psychology everybody else is. Well, maybe I'm wrong. Maybe everybody else is right. And that's why it's tough. It's very tough. And this is the point of the article. Humans have a very short-term memory of pain. And the reason is that back in caveman days, Ugg goes out of the cave and he gets attacked by a saber-toothed tiger, right? So he runs back to the cave. He escapes and he runs back to the cave. Now, it's a terrible, painful experience, right? Getting attacked by a saber-tooth. But if he remembers that pain to the extreme that it was at the time, he would never leave the cave again, right? So as a matter of survival, we have a very short memory of extreme pain. I mean, think about it this way. Talk to any woman who's ever had a baby, and they will tell you it's the worst pain they've ever had, right? But if they remembered that pain to the actual moment, after you had one kid, nobody ever have a second kid, right? Too much pain. So we forget about it over time. And it's just our psychological makeup. It's how we function, because if we remember that pain and relive that pain constantly, we can't move forward. This is the problem with PTSD, right? They relive that agony and they can't move forward. And that's the markets. If we remembered all the pain and all that agony we went through when we lost half our money back in 2008, we would never move forward. And so this is why we have a very short-term memory of that, but it's important not to forget the behaviors that we were doing that got us into trouble in the first place. And that's the biggest problem that investors have. And particularly today, given that there's a massive number of investors in the market that have never been through a bear market, a lot of that experience, that knowledge of painful bear markets and what happens and the bad investment mistakes we make have all been forgotten. And we're repeating those things again. That article's on the website, realinvestmentadvice.com. Have a great day. We'll be back here tomorrow. Michael Leibowitz will join us. We'll talk a little bit about where we are on inflation, Fed policy, and what that means for you and your money. See you back here tomorrow on The Real Investment Show. I'm your host, Lance Roberts.
Whoa.